Fundamental analysis for systematic trading will help you understand what could change price over time, and more importantly, how to structure that understanding into a decision framework. We will approach this in the most systematic way possible. My name is Ashim Nandi. I'm a system architect with 10 years of experience between running an IT company and full-time trading. Data without structure is noise. Structure without probability is illusion, and time is where structure, probability, and reality finally meet. Here are the chapters that will help you understand these concepts better. First, the three layers. You will understand that fundamentals operate across business, economic, and narrative dimensions, each with different predictive power. Second, time and probability. You will understand why every fundamental view must answer two questions. Over what horizon does this matter? And what is the probability distribution of outcomes? Third, from stories to systems. You will understand how to transform fundamental insights into systematic inputs that integrates with technical execution. Once you go through all of these concepts, you will approach fundamental analysis as a decision framework, not a tool for finding good companies. And with that understanding, you will also see how fundamentals, time, and probability form the intelligence layer. Think in odds, act with discipline. Fundamental analysis fails when people confuse stories with structure. Consider the statistics. Only 54% of analysts' target prices correctly predict future price direction. That is barely better than a coin flip. And when you account for systematic optimism bias, it is actually worse. Yet, systematic factor strategies using the same fundamental data have generated 4 to 5% annual premiums for nearly a century. The difference is not the data. It is a framework. Fundamentals operate across three distinct layers. Each tells a different part of the story. Each has different decay characteristics. Layer 1, the business layer. This is where most analysis lives. Revenues, margins, competitive dynamics, execution quality. The research is clear. When a company reports strong profits but very little real cash actually comes in, that gap matters. Companies whose profits are supported by real cash beat companies whose profits are mostly accounting by around 10% a year. Why? Because people trust profit numbers too easily. They assume profit today means profit tomorrow. But profit can be shaped by accounting rules. Cash is harder to bend. So when profit and cash disagree, cash is usually telling the truth. That gap between profit and cash is really a signal about how real the earnings are. Layer 2, the economic layer. This is the world every stock lives in. Interest rates, credit, liquidity. When money is easy and credit is everywhere, markets usually feel great. But history shows those periods often lead to weak returns later. Easy money feels like growth, but often it is just borrowed from the future. Different sectors react differently to rates. Banks and energy often struggle when rates fall. Utilities and real estate usually benefit. This layer does not tell you what to buy. It tells you what kind of weather you are trading in. Layer 3, the narrative layer. This is the most ignored part. What does the market already believe? Returns don't come from good growth. They come from growth that surprises. Companies everyone expects to grow fast often disappoint. Companies nobody expects much from can explode when they do better than expected. Growth itself does not predict returns, surprise does. So the real question is, what does everyone already believe? And where might that belief be wrong? Now you understand the three layers. business reality, economic weather, market belief. But knowing these layers does not tell you when they matter or how confident you should be. That is what time and probability give us. Every fundamental idea has a lifespan. Most traders ignore this. Some ideas work for years, some work for months, some dies in weeks. Value ideas tend to last the longest, often 3 years or more. Quality ideas last about 2 years. Momentum ideas fade much faster, often within a year. In simple terms, every insight decays. If you wait too long, your edge leaks away. A 1 month delay can cut your edge by around 7%. For big stable companies, more than half of the information value dies in the first month. So time is not a detail, it is a part of the edge. A long-term idea needs different sizing, different patience, different risk than a short-lived one. Time tells you how long your idea can breathe. Now probability. Traditional analysis talks like this. Fair value is 150. Target price is 180. Reality does not work like that. Markets live in uncertainty. Big surprises happen far more often than textbooks say they should. The average outcome is rarely the most common outcome. So systematic traders do not make one forecast. They build many possible futures. Base case, good case, bad case, and everything in between. They give each one a chance of happening and combine them. That gives you expected value, not fantasy certainty. Base rates matter too. Historically, the market goes up about 73% of the time in a year. Yet only about 8% of big funds beat the market over 20 years. So before trusting your idea, you must respect this. Most ideas fail. This is not negativity. It is calibration. Good traders update beliefs like scientists. Start with history. Add new evidence. Adjust slowly. Never fall in love with one story. Now you have layers. You have time. You have probability. The question now, how do you turn this into rules? Shift 1. From single answers to ranges. Not fair value is 150, but 30% chance of 120, 50% chance of 150, 20% chance of 200. The range is honest. The point is a lie. Shift 2. From one story to many futures. Not earnings will grow 15%, but 40% chance of 10%, 35% chance of 15%, 25% chance of 20% or more. Expected growth is not the same as the most likely growth. Math does not care about comfort. Shift 3. From trusting forecasts to measuring bias. The most optimistic forecasts are wrong the most. Extreme optimism is a warning sign, not a comfort. Shift 4. From ignoring history to respecting base rates. If only 8% succeed long term, your confidence must be earned, not assumed. Strong priors prevent arrogance. Shift 5. From good company to wrong expectation. Returns come from surprise, not quality alone. What matters is not the story, but where the story breaks. Now fundamentals meet technicals. Fundamentals tell you what could move price. Time tells you over what horizon. Probability tells you how big and how risky. Technicals tell you when to enter, when to exit, when you are wrong. Not fundamentals versus technicals. Fundamentals are the what. Technicals are the when. Fundamental analysis is not about finding good companies. It is about understanding what could change price over time and structuring that understanding. In our first Principles of Trading series, we are building a complete systematic framework to help you make better decisions under uncertainty. Fundamentals tell you what to trade. Technicals tell you when. Next questions you should ask: how do you measure uncertainty itself? How do you know when edge is real? How many trades before skill beats luck? That is probability and statistics, the language of uncertainty. That is next. Think in odds. Act with discipline. See you in the next one.